Hello, everyone. I hope you're doing well today. Welcome back to the channel. Today, we're going to be discussing the idea of front end loading a whole life insurance policy that's really designed for your IBC process or your policy. So, as always, I am not an insurance advisor. I am not any type of financial planner. I have no interest in whole life insurance in any capacity. I am just passionate about personal finance. I bring this up a little more in detail because somebody called me out saying that I may be influenced by insurance. I have no interest in any capacity in any insurance company, other or otherwise. In fact, the only reason I use Equitable Life illustrations is just because it's um, the easiest accessible illustrator that produces decent IBC illustrations. So, anyway, let's get to this idea. So, let's talk first about the idea, right? So, a lot of people that consider IBC, they kind of fall into two categories. One is where they have good cash flow, but no savings, and the other have savings and are looking to maximize um, the process. And one of the biggest things is well, okay, this all sounds great. You've watched the videos, mine and otherwise, and you say, okay, yes, I want to move forward with IBC. And the question always comes up, well, can I dump all of my savings into um, into my whole life insurance policy? Now, to explain the infinite banking concept really quickly, as I typically do every video, the idea behind this is you make your dollars. These dollars will then flow into an infinite banking concept process, which is simply a specially designed whole life insurance policy. Specially designed, not so much, but it does have to be designed very specifically. The money that's inside of here compounds, and when you use your money, typically through loans, this money that's in the infinite banking concept and the whole life policy continues to compound despite the fact that you are using the money. And typically, you're going to be using it on spending or investments. And ideally, the money that you make from the investments is going to go back into the whole life policy. And ideally, you want to try to limit frivolous spending from the infinite banking process. So this idea is that you just constantly have this constant flow and loop of money that is continually compounding. And as I've discussed in my other videos, the idea here is to recapture the lost opportunity cost. And that lost opportunity cost, typically speaking, is the money you could have earned if your money was sitting in savings, and also just essentially the interest expense and that you would otherwise have made by having this money compound, right? So it's kind of a little bit of the best of both worlds here. I have way more detailed videos on this. Just watch those. Don't take my 10-second explanation of this as gospel, right? So let's look at a scenario. Let's imagine somebody has, they've got $50,000 saved, and they can afford approximately $20,000 per month, rather per year as a premium. Now, these numbers can vary. I just picked these for illustrative purposes, just so you can see kind of how the numbers actually work. So let's first look at what a traditional whole life policy looks like if you were not to dump a lump sum of money. Let's just say that you wanted to do $50,000 a year. Okay. So first things first, your actual required premium on this is only $20,500. I say only loosely, of course, um, but you're going to pay a total cash premium of $50,000. So this difference here, at least as it relates to Equitable, is known as your EDO, which is your accelerated deposit option, something along that effect. Long story short, it's basically extra payments that you make on top of the required annual payment to purchase single pay paid up insurance, PUAs. Okay. And those paid up additions. So from this $50,000 in the first year, you have roughly $40,000 available to you, and so you've got 80% of the money that you put in. Some policies are worse, some policies are better. It depends on a whole host of factors. I've done this for a 30-year-old male that's in good health. You could do this for anything, and there are some insurance companies that do better off of the get-go. A few people have mentioned Manulife in the comments, and I believe you can get a 90% of your cash from Manulife in the first year. Pros and cons to them all. Work with a practitioner that will help you really design this for you. Okay, but you'll see all the way through your required premiums remain at this 20,000, and your cash premiums, the total premium paid rather, remains at 50. Your break even period, as you're sitting right in this range in between year 5 and year 6. I mean, if you're outlaying $50,000 a month, rather a year, I would actually consider, from an effective standpoint, from an actual, like, dollars and cents, that your real break even's kind of 4 or 5, because roughly the $6,000 difference here is not a massive deal when compared to the actual annual premium paid. Okay. Long story short, the actual real break even, though, is year 5 or 6. So this works out really good. And if you could afford $50,000 for a few years, there is this concept known as offset, which is essentially where, after you've paid enough premiums in, the insurance company will basically use the dividends that are earned from the policy and sell off those paid up insurance contracts that have been purchased to then pay your annual premium. So you'll notice the required annual premiums here for the first 5 years remains at the $20,500. You're going to pay in the full 50 though. Remember, with that difference. And after that, though, the earliest you can offset the policy, assuming everything stays the same under the current dividend schedule, is the 5 years. And you'll notice that up to year 5, you have a total death benefit of 21 million, and this actually starts dropping before it starts going back up again years down the road. However, your cash value continues to grow, and this is because as time progresses, your dividends exceed the annual premium, and so you actually end up repurchasing paid up additions yet again. So this is what it would look like. But the thing is, a lot of people say, I can't afford to pay out, $50,000 over and over and over again. I have 50 grand cash, but I can really only afford this $20,000. So I did this illustration here. So I said in year 1, you did that full $50,000, but then after the fact, you only put in the required annual premium, and you can see that these and these are equal. Okay. So you'll obviously have less cash value. That's without a doubt, except for the first year. I don't know why this happens. I'm sure somebody in the comments might know. Let us know. I'm intrigued. But you do have a little bit more cash value in the first year. Subsequent years, you have less, obviously, because you're depositing less money. And your break even point ends up being the year 5 or 6 mark, which actually is identical to the other, when you're putting in full payments. So, really, the actual performance um, of your whole life for IBC purposes, okay, um, doesn't actually change if you do a couple lump sums. And this is why, uh, you know, whole life is actually incredibly flexible, because you could start with a higher premium. Let's just pretend that you could afford 50,000 for 3 years. Well, you could always pay it for 3 years and then drop this $20,500 after, and your cash values will remain relative to the amount of deposited to be roughly the same amount of money. So, what does this do, though, to the break even, rather the offset? Well, this is where it gets a little bit more wishy washy. It actually adds an additional 5 years if you wanted to offset this policy. So, you do have to be careful. And I've spoke about this in other videos in terms of designing policies. You really need to make sure that you can afford your cash premiums. I don't want to say no matter what, because these are tremendously flexible. But if, your max is 50 grand, well, don't make your base premium $50,000. Make it something that you can handle. Maybe take $40,000, put it into IBC, save the additional 10 until you're very comfortable, and you can always start up an additional policy after the fact. Okay. So, how do we determine what these two numbers are? So like I mentioned over here, the annual required premium, and I'm just going to abbreviate these as saying the required annual premium, the RAP, okay, plus the EDO is equal to your actual cash premium that you pay, okay? Now, your maximum allowable amount of EDO is a function of how much life insurance you have, which is a function of your base premium. So, what this means is that when you're trying to determine what a maximum lump sum is, now thankfully, Equitable makes it very, very easy. You can just say that I want to solve for the maximum amount of money here, but not every illustrator is that simple. Long story short, talk to a practitioner. What they'll do is they'll say, okay, if you have a lump sum of 50 grand and you can afford X, does this fit the actual model? Because you may, for example, have a $50,000 cash savings that you want to input into an IBC policy, yet you may only be able to afford $10,000 a year of a premium, and these just won't work. You would actually likely have to put, and I'm ballparking these, I haven't run these illustrations, but you'd probably have to put $25,000 a year for the first 2 years and then bump your premium down to 10K after that on an ongoing basis, right? And I'm just basing that off of half of these. So um, that's how that works. Now, performance-wise, in terms of internal rates of return and the differences, there is a impact. I don't think that infinite banking is all about returns, although I do think the returns can be quite attractive. So when you max out your cash premiums and continue making those increased maximized EDO payments, then your internal rate of return, kind of peaks in around the 4.31%, but roughly I ballpark it 4%. Okay. Now this is based on current values. This is based on this policy. This is based on this premium. There's so many factors that goes into it. I don't want you to get hung up on the internal rate of return. When you only make one additional payment, your rate of return does get impacted quite significantly by a factor of about 25%, right? You've lost a percentage point. And sometimes, well, all the times more than a single percent, right? And so you just have to be conscious of that. The concept still works. It still works phenomenally at these numbers. Just something to be aware of. So I hope that makes sense. If you have any questions, let me know. If you disagree with me, let me know. If I forgot something, let me know. Uh, just be aware that I will respond. And what I would appreciate is I've had this happen a bunch of times. People come and they say they disagree for X, Y, and Z reason. I respond, and then they never respond again. Be open to the discussion. I really don't take any negative opinions or anything like that to somebody that disagrees. I just like having a conversation about this stuff, and you know, I'm I'm here to have my eyes opened. This has been a journey, and I'd like to help other people and continue that. So, let me know, like the video, subscribe to the channel, and we'll talk to you next time.